Tell me about the problems that banks have that people aren't taking a close look at. What are the skeletons in the closets that don't get talked about usually when we talk with professionals who sometimes have an interest in presenting, let's say, the best foot forward?
Sure. Steve, I think it's well known that there's somewhere in the range of $1.5 to $1.8 trillion worth of commercial real estate loans that are coming due over the course of the next 4 to 5 years. During 2009, there was about 200 million, and a lot of that was extended. I think you've heard the phrase coined, extend to pretend. At some point, the banking community is going to have to deal with these maturities. If there's not a refinancing market, how is it going to be dealt with? Is it a modification? Is it a foreclosure? REO, real estate owned, taking back the keys to the property? Or is there going to be some other solution? I think a lot of the banks right now have not taken what people refer to as the mark and writing those assets down to the level that perhaps folks think the market value is today.
Now, we heard on the panel this morning that very few banks want to do that because they don't have to do it, at least right now, because of the low interest rate environment. And should interest rates change, then we've got an entirely different environment, of course. How long can this extend and pretend go on? Is that the same thing as asking how long are we going to have interest rates this low?
Interesting question. I think at some point, for the origination markets to really open up, the banks are going to have to deal with these issues. So a lot of people say there's a stalemate right now between the equity that's sitting on the sidelines that looks to potentially buy these assets, and then the banks themselves who are holding these mortgage loans. That's the bid-ask spread. In terms of when they're going to deal with it, it's going to take one of several things. It's going to take a government action.
For example, what kind of action?
In terms of, for example, setting a set of guidelines that actually prescribes how banks are supposed to specifically mark these items. It could be a regulatory angle, it could be an accounting standard change. There's been a lot of that already.
We've had some of those already.
We've had some of that,
yes.
And they've had their fair share of controversy. My sense is, and then you've also had some transactions which have occurred, albeit in a world of distress. My sense is that we're getting closer to a point where people are getting ready to transact, and absent any more intervention or changes at either a regulatory or an accounting policy level, at some point in the next 12 to 18 months, you're going to see a lot more transacting with these loans. Larger banks will have the benefit of multiple other income streams and trading operations being able to cover, if you will, the need to make large write-downs on these assets. Smaller regional and community banks will be subject to a different set of dynamics. And then you have banks that are on FDIC watch lists right now, which desperately need capital. And it's interesting that they need capital to survive, and yet we have this capital that's on the sideline, and we're still not getting to a point where there is a flow of activity.
What do you think is the ideal solution? Do you think that there's something positive the government could offer here?
It's interesting. You got a lot of industry observers commenting on what they believe needs to happen. My lens, talking to my clients, some of whom are private equity and institutional investors, some of whom are banks, and then also talking to folks who have dealt frequently and recently with government agencies, is that actually needs to involve a cooperation of multiple parties. It might be a situation where we have private equity comes into part of the equation, existing healthy banks are also part of the solution, and then perhaps you've got FDIC as a backstop.
Even for commercial property, you're suggesting?
That even for commercial property.
So after the bank bailouts that we've had and the sentiment out there, do you really think there's going to be much appetite for public money to be used for commercial property?
Well, I think it's a backstop. I think the bailout of the big banks has been just that. It's been a bailout of the big banks. And I think Sam Zell made the comment today, is like a lot of folks out there don't realize that bailing out the big banks on Wall Street is bailing out Main Street as well, because those banks and those institutions are critical to Main Street.
Right, that gets translated differently through the politics, of course.
It does, of course. However, I think a lot of the regional and community banks have not been recipients of that funding, but they're actually the ones who have a fairly large exposure to lending on the commercial real estate side. So
that's interesting, because I've read someplace that the top 20 banks basically have very little exposure to commercial real estate. And it's the big regional banks and the small banks.
Yeah, big regional and community banks.
And community banks with construction loans and so forth.
Yeah, the construction loans are challenging, just lack of cash flow. And I think a stabilized asset is an easier one to deal with from a loan perspective, and then to the actual underlying asset. But a non-cash flowing asset, one that needs continued investment or incremental investment, is more challenging to work through. Whichever way you look at it, Steve, it's going to require participation from multiple constituents. And so, I'd like to think that, given my lens in the world right now, that the regional and community banks, some of them will be healthier than others and have an opportunity to participate in this process, to expand their footprint. I'd like to think that the FDIC or other government agencies will be there to endorse or bless a transaction. I'd like to think that the private equity participants can also play an important role of recapitalizing some of those institutions into a healthier state.
Is that something like what was done with the SNLs in the late 80s, early 90s? In other words, you had institutions flat on their back. You had government come in and at least prop them up to the extent that they didn't go out, which they would have without the propping up. And then you had bottom feeders come in and buy them up at prices and that were very attractive if you had confidence in the market. And of course, they made a killing. By the mid-90s, some of these players that had consolidated a lot of these little banks were big regional players themselves, and they had done exceptionally well.
Yeah. Different world today, obviously, and I have heard people reflect upon, why aren't we doing an RTC type structure today? There's definitely a different political landscape right now, and there's also a very large volume. If you look back to the RTC days or the savings and loans, and you compare it to the volume of distress out there today,
so there's already been far more money lent to AIG alone than there was the entire SNL industry at that time.
Absolutely, and I think back in the SNL crisis, or if you will, you also had a much different array of loan product. And since the SNL crisis, you really had proliferation of new sources of capital. One of them was CMBS, and so that was kind of post SNL, and I'd say that that has added to the complexity. And then you add to that as well multiple participations by different banking institutions in the one loan, and you have various forms, whether it's syndication or going out there and securitizing product, that basically makes for a much more complicated capital stack. In some instances, we've seen a couple of examples already, where the complexity within the capital stacks today is such that folks are saying the only way to deal with this is through some kind of cleansing process, whether it be a foreclosure or more pointedly, a bankruptcy. And we have seen examples of that.
So given that commercial real estate is a lagging indicator, and what you're suggesting is that things are coming to a head, as it were, that some of the problems that have been able to be extended, and pretending that payments were being made when in fact a lot of concessions were being made behind the scenes, that appears going to be forced to come to an end. The kinds of changes you're talking about may be starting to begin. How long of a process is it until the market's sort of washed out and ready to look ahead to more normal times? I'm assuming we're talking years here.
Steve, I wouldn't be here if I knew the answer to that. Crystal ball aside, there's a lot of issues that need to be worked through. The good news is there's a lot of capital on the sideline, and they are patient pools of capital, and they want to deploy, but they also want to deploy in an environment in which they have a little bit of certainty around the investment parameters. There's been a lot of concern about the bailout of the big banks and the impact that that's had on compensation and other areas of scrutiny from the investing public. So that's created a little bit of angst. I think there's also a little bit of angst in the system right now in terms of people that do participate in like a loan sale program or process that is being run are frustrated at the number of other bidders that are coming in and bidding up the price of the assets or the underlying quality of the information. So systemically, there are a number of things that are roadblocks to an efficient recovery, if you will.
What are some, or who are some of those investors? We're talking about U.S. commercial property here, I assume. And who are some of these investors that are crowding out the field? Are they overseas investors, for example, sovereign wealth funds, perhaps?
Yeah, there's an array of different investors, and you're obviously familiar with the private equity capital. I think one of our panelists today talked about the $78 billion sitting there on the sidelines, ready to deploy into commercial real estate. Majority of that is looking at paper and not the underlying assets. So you've got that pool of capital. You've got the pool of capital with, in the public markets in the last 8 months, 9 months, the public markets have been very positive towards real estate, whether it be newly formed REITs that are going out there to pursue a mandate in buying distressed opportunities or originating. Or alternatively, recently we've had a number of blind pool REITs going after specific asset classes like hotels. So there's been 30+ billion raised in that area. And then for the...
So REITs are very positive and bullish.
Yeah, and the public markets have provided some liquidity there. And it's interesting that source of capital, the public markets, provides an interesting vehicle for real estate because it gives people the exposure to the asset class, but it also gives them liquidity. So you can sell down a portion of your holding, whereas it's tough to sell down a portion of an office building.
So how interest rate dependent is all this? And then continue your thought.
Can I come back to the interest rate dependency?
Yeah, okay, yeah, finish.
And then to add category number 3 is you've got large pools of these REITs that are non-traded, and I think that's about $70 billion year to date. And then you have individuals, high net worth individuals domestically who are looking at this as RTC2, saying this is how all the big guys today got to where they are. They made some prudent purchases during the last down cycle and were able to come out of that cycle very strong. And then you've got offshore capital, and with exchange rates where they are right now, you've got offshore private equity also looking at the US saying risk adjusted, this is a good place to be given asset prices right now. Sovereign wealth, even though some sovereign wealth have got their own share of issues, I think there's still a huge pool of capital out there looking for an allocation towards US commercial real estate.
I mean, that's the very group that can afford to buy and sit and wait, I would think.
They're long-term players, without a doubt. Yeah. And a lot of them are looking to put commercial real estate into their portfolios as a tool for diversification. Sorry, I went on there.
That's okay.
Do you want me to address the
interest rate issue, please? Yes, because
can you repeat the question?
The question is, isn't all of this interest rate dependent? In other words, at some point, interest rates are going to have to rise, and the timing is everything. And if rates rose sooner rather than later, that could throw a pretty big monkey wrench in some of these scenarios, couldn't it?
Without doubt, without doubt. I mean, I think if we listen to some of the panels this morning, I would say there was a consensus view that rates need to start being ratcheted up now, to curb fears of high or hyperinflation down the track. And so, right now you look at the lending environment and the cost of funds is very low, but there isn't a lot of lending going on. It does dampen as interest rates go up. I think what we did here, however, Steve, is that you could still go up a couple of percentage points, and that the dampening effect on investment in commercial real estate would be not so significant, but yet it would have a moderating impact, in the macro economy.
And then there's the question of really whether folks may be advocating slightly higher rates, but whether the economy or the authorities would actually do that, given the fragility of the economy right now.
That's absolutely true.
So another question, Dubai World, we have to ask you about that. And even though it looks as, I guess we're about 2 weeks since that's happened, it's been announced, the waiting to pay back debt. At first there was a big reaction, now there's less of one. What kind of an effect does that have on U.S. investors just in terms of thinking about investing in projects in real estate in general, making them more cautious, or in what other ways might it affect investor psychology?
Yeah, all of these items impact investor psychology. Seeing a large public REIT file for bankruptcy protection impacts investor sentiment. It impacts a segment that they're in. Seeing another privately held company file for bankruptcy as well in the extended hotel segment also creates an impact on investor sentiment. Similarly, Dubai World has an impact on the investor sentiment. I don't think it's any different to other investors who, in this last cycle, invested in commercial real estate and employed leverage. I know some participants right now look at that set of facts as being creating conditions that might be appealing to an investor. I see other folks looking at that saying, well, that creates a lot of distress and dampens, investor sentiment. I think it depends which lens you're coming from. In many instances, given my role, I'm subject to limitations on what I can share. But I think it does obviously have an impact on investor sentiment. What I would say, though, is, overall, I would expect over the next 3 to 5 years' time to see a broader deleveraging of the commercial real estate markets, perhaps back to more sustainable levels. I've heard a lot of people touting somewhere between 60 to 70% LTV. The question is, what is V? And I think that's driven to some extent by leverage. My expectation is that the public markets, the private capital, the offshore capital, and the banking sector, as well as the government, are all going to be part of this solution, if you will, to have a broader deleveraging of real estate, commercial real estate in the U.S.
And that will happen over roughly what kind of period?
3 to 5 year period of time.
3 to 5 years.
Yeah.
Okay. Let's switch topics quickly to distressed debt.
Sure.
Give me your sense of what the contours are of distressed debt in the U.S. and then in Europe. It seems to me, from what I'm reading, that in the U.S., the amount of distressed debt has come down quite a bit in the last year, where it looks like Europe may be just about to ratchet up. What's your view? My lens on the U.S. is a lot sharper than it is in Europe. And I would probably contend your view that things in the U.S. have been dealt with. I'm not sure what your exact words were there, but I think there's still a huge amount of distress in the system in the U.S. for debt underlying commercial real estate. There's a huge amount that's coming up over the next 5 years that has to be dealt with. I think similarly, but on a lesser scale, in Europe, the issue has to be dealt with. In some respects, some of the marks have been taken in Europe under IFRS or under the US accounting models. Some of those marks to mark the loans down to their market value have not occurred. So, in terms of scale, the US market has a huge nut to deal with in that regard. Let me just read you something from the FT, because this is what I was referring to. The rating agency, talking about Moody's here, now forecast that default rates for US junk or speculative grade debt will peak near 14% in November before falling back swiftly to 4% in a year's time. That sounds like a big change.
That is a big change, and to be honest, Steve, that's probably one that I don't want to comment on, just because of the speculative nature.
Is there more you can offer though on your views of distressed debt?
Yeah, it's interesting. We work as a practice with a number of different constituents within the world of distressed debt. We work with debtors who are trying to deal with banks, modify their loans, see if they can extract alternate scenarios with their current borrowings. Then we have the lenders who we are dealing with, who are trying to work out, what's this loan really worth? What are my options? Do I take the keys back? Do I extend or pretend? Do I modify it? Or do I sell that loan to somebody else and make it somebody else's problem? Or does the government come in? And then I'm dealing with the investors as well, who are trying to work out how they can play effectively in this space and be part of the solution. So you look at those three constituents, and there's a lot of different, you can come in at different lenses. Interestingly enough, we have the benefit of working with different clients across that kind of cycle and provide a lot of that perspective to different clients, based on what we see in the marketplace. I would tell you, there's a lot of distress to go around right now. And my view is that it is going to take a diligent period of time to work through the distress. It's certainly encouraging that the capital markets on the public side, for public REITs and new pools of capital are being raised. That's a positive. It's an absolute positive right now that the markets have been able to absorb and oversubscribe a couple of recent CMBS offerings, some of which are TALF-backed and some of which are non-TALF-backed. So, I see those as two positive signs, and we see that one or two transactions have occurred with FDIC-sponsored deals. So you look in the world of distress and you say there are some positive signs. We'll get through this, and it will result in a deleveraging of real estate. It is also going to result in a shift, if you will, of real estate wealth from one set of hands to another set of hands. And there might be some folks who are on both sides of the table.
Might be. Thanks for joining us.
My pleasure.